Imagine buying gold, watching the price go up, and then when you try to sell it, the number suddenly looks different. See, a lot of investors think something went wrong, but assuming you worked with a reputable dealer and paid a fair price for the product, what you're seeing is normal. You're simply moving from one side of the market, which is the retail, to the wholesale when you sell. After working with thousands of precious metals investors over the years, I see this confusion happen all the time. And it usually comes down to three simple things nobody explains. Today, I'm going to break them down in plain English so you understand exactly how buying, selling, and liquidation in the metals market actually works. I'm also going to cover why transparency of the dealer you choose is imperative to avoid making costly mistakes. Let's start with the first idea, buying versus selling. There are two different markets. Here's the thing most people don't realize. When you buy gold and when you sell gold, you're not in the same market anymore. Think about real estate. When you buy a home, you're not just paying for the land. You're paying for the construction, labor, materials, transportation, the builder's margin, and all the things that brought that house together. Physical gold and silver work the same way. The spot price is simply the global wholesale value of the raw metals. But when you buy a coin or a bar, you're buying the finished product that has gone through the entire supply chain. Mining, refining, minting, distributing, dealer to retail investor. So as a retail investor, you usually buy at the retail pricing. But when you sell, you're stepping into the wholesale side of the market. Nothing's broke, nothing's changed. You simply walked around the counter to the other side of the store. I also hear people say, spot prices look different. This is where most confusion happens. People say to me, Alex, I bought gold at one spot price, but why is the spot price different when I sell? Because the truth is, there isn't just one single spot price. Every financial market in the world works this way. Gold dealers operate the same way. Ask price, what you see when you're buying. Bid price, what you see when you're selling. And the key insight most investors miss is this. The spread is not a penalty. It's actually a signal. Think of it like this. When the spreads are tight, it's like going to Costco on a Saturday morning. You see a lot of activities, smooth pricing, strong liquidity, but when the spreads start widening, it's like having an Uber surcharge during a storm, demand shifts, volatility increases. For example, right now, as of March of 2025, the premium on silver American Eagles are higher and in comparison to other similar bullion products. This is driven mainly because the US Mint's production delays, along with the brand recognition and the trust that they command the Silver Eagle. So pricing adjustments reflects the market. So instead of seeing the spread as something negative, think of it as a real-time indicator of market conditions. And in order for you to be profitable, you need to sell the products above your purchase price to overcome the premium. Now let's talk about the third idea. How do you actually sell gold? This is a question I hear all the time. Okay, Alex, I own gold, but how do I actually sell it? The answer is simpler than most people think. Most investors have three main options. Number one, you can sell it back to a reputable dealer. I suggest getting quotes because each firm's buyback pricing might be different. Number two, trade or upgrade into different metals depending on the market conditions. And consider looking at the gold to silver ratio, for example. Third option is to do a combination of the first two. Professional dealers, including a firm like ours, Allegiance Gold, maintain an active buyback desk for exactly this reason. Because liquidity matters. Gold isn't meant to be something you're stuck with. It's meant to be something you control. And no, you're usually not walking into the grocery store paying with gold coins. Think of physical metal more like a financial insurance or even a reserve asset. You hold it for stability. And when the time comes for you to rebalance or take profits or reposition, you simply liquidate through a dealer or a marketplace. Now, I really have to cover this because the product that you bought matters. Here's one important assumption in everything that I just discussed, and that is you purchased the right product at a fair price. Because not every gold or silver products in the marketplace is priced the same way. Look, some products like basic bullion coins and bars tend to trade very close to the underlying metal price and usually maintain strong liquidity. They're going to be close to the spot price. Other products can carry very high markups, which can affect the resale value regardless of what gold prices are doing. Think of it like buying a car. If you buy a reliable, well-known model that people recognize, it's usually easier to sell later because the market understands the value. But if you buy something rare, complicated, or heavily marked, the resale market may look very different. The same idea applies to precious metals. That's why what you buy matters just as much as when you buy. If you like to learn more about this topic, we actually did a deeper discussion called Why Some Top-Rated Gold Dealers Are Dangerous for Investors. One of the topics I covered is that celebrity endorsement firms are a red flag. Companies that sell physical precious metals that do not have live pricing on their website is a red flag. Because folks, think about it this way. These are actual commodities. No dealer produces it. It comes from the most reputable mint. Think of the United States Mint, the Perth Mint, the Royal Canadian Mint, and the British Mint. These are sovereign mints, and then on the other hand, you have private mints that produce the physical product. How is it possible that the same product, Company A sells it at an X price, and Company Y sells it 20, 30, 40, 50% higher in price? See, when you're investing in physical precious metals, relationship with the right firm matters. You need to understand that you're not a coin collector. You're not looking at having such a high premium and intrinsic value, because what that does, it actually puts you in a negative position when you start. And as the prices go up, when you look at the spot price and you say, I invested in gold when it was $2,000, right now gold is over $5,000, I should have doubled my investment. Conceptually, from a spot price perspective, is correct. But what you want to pay attention to is what products did I invest back then and what was the premium in comparison to the spot price. That is key, because if you pay too much premium up front, that means your profit would be impacted severely. That's why products matter. We break down the right questions investors should ask before buying so they understand exactly what they're getting. Because when the product is right and the pricing is fair, the market is liquid. Buying and selling metals becomes much clearer. In closing, one of the biggest mistakes investors make in buying metals without ever understanding how the exit works. And that's when confusion shows up later. But once you understand the difference between buying and selling, the entire market starts to make sense. If you're holding metals right now and want clarity on how liquidation works, or you're considering buying and want to understand the process first, those are the conversations worth having before you make a move. And if you found this helpful, make sure to subscribe, follow, along with giving us a thumbs up. Because my goal here is very simple, to give you real education so you can make smarter and more confident decisions with your wealth. Because gold isn't something you're stuck with. It's something you control. And understanding how buying and selling works turns confusion into confidence. If you got value out of this video, my name is Ebkarian. I'm the co-founder of Allegiance Gold. There are 3 things we do differently from a lot of firms, and we're unique from that perspective. Yes, we lead with education. Yes, we're interested in a relationship and not a transaction. But most of all, we are radically transparent. When you make an investment with Allegiance Gold, out of the gate, you know what the spot price is. You will know what the wholesale market is and what the retail price you're paying. No gimmicks, no game, straightforward, so that way you have the confidence in making the right decision. Because you know it, and I know it. Every business is in business to make a profit. We've decided years ago, instead of us paying millions of dollars for celebrity endorsement, to borrow that trust and establish a trust with you, We want to be direct. We want to have that relationship where we work on the three basic pillars. We lead with integrity. We want you to know the difference in product A, product B, product C. As a matter of fact, if this is the first time you're making an investment, numismatic coins, proof coins that have so much of a high premium might not be the right fit for you. You might want to consider on a basic plain vanilla bullion coins. You might even understand why is it that fractional coins tend to cost a little bit more than generic one ounce. These are the discussions that we're going to have, so that way not only do you have the confidence, but the clarity to say, I know what I'm getting myself into, I understand why I'm doing it, and I know what my exit strategy is. If you got value out of this video and you want to possibly have a conversation, book an appointment, reach out to us. We look forward to working with you.